Good afternoon, SVN. Welcome to the SVN Investor Economic Forum. We had a little bit of a change this afternoon. Our Robert White is unable to present, so we have the next best thing, Jim Costello, who is going to present this afternoon with a great presentation. Jim has worked in the CRE space on issues of urban economics since 1990, including a 20-year stint at Torto Wheaton Research. Jim's also provided advice to the Treasury Department and other policymakers in the aftermath of the global financial crisis, and he helped educate these professionals on commercial real estate performance. He's also a member of the Commercial Board of Governors of the Mortgage Bankers Association and is working there as well to help policymakers understand our industry. He is expanding the capabilities of the Real Capital Analytics team on issues of real estate market dynamics. He has a master's degree in economics and is a member of the Counselors of Real Estate. So without further ado, I'm going to present Jim, and I just want to remind everyone with questions, if you could hold them till the end of the presentation, and then we can let Jim answer them. So welcome, Jim.
Hey, thanks so much, and thank you everybody for dialing in to hear what I have to say today. I'm going to be giving an overview of the commercial property markets in the United States. And, in the background, if you can see, there's a little bit of rain. You might see some thunder and lightning from time to time. We're getting it here, the remnants of Florence. It's far weaker than what hit the Carolinas earlier, and feel so bad for everybody down there. In any case, today I have four areas that I'm going to address. I'm going to be taking just an overview of the investment markets in the United States, sort of what's been happening, price trends, and why, a little bit of the influence of cross-border money as well. We have a big report coming out shortly on the debt markets. I'm going to give you a little bit of a preview of that in terms of what's driving the debt markets in the United States and the amount of capital that's coming there. I'm going to jump into issues around different property sectors and a few particular stories on each main sector there, and then get into the issue of what's going to come next on prices. So on that issue of the United States and sort of an overview of where the market's at, the deal volume, people look at that and they think it's a bit of a roller coaster. It's up, it's down, but it's been on a downward trend since 2015. What I'm showing here is kind of a noisily monthly pattern of data, but it's clearly not at the peak levels it was back in 2015. We're on a downward trend on that. And into July, the most recent figures all the way here at the right, it was down quite a lot for a July period. So there's a couple stories that come out of that with investors. Some people I talk to about this issue, and they look at this almost hopefully. They think that, hey, deal volume is falling, the market's going to collapse, I'm going to be able to come in and buy everything on the cheap. Thinking that they could be the next Sam Zell maybe, and buy everything in a distress type situation. But that's been the thought for some folks since 2015. But volume has been coming down a bit, but prices haven't moved all that much. They climbed for a little bit at first into 2016 at a strong pace. The pace of growth is moderated, but the orange line here, that's the RCA Commercial Property Price Index. And it's been fairly stable for the year to date for all property types. It's up about 7% year over year. Up 7% is not up a double-digit pace like from 2013 to through 2015, but still, it's not what some of these investors were thinking. They were thinking that, hey, it's a panic world and everything's going to be on sale. But it's a little bit different today, and there's a couple reasons for that. You have buyers and sellers further apart because of where the markets are at, but there's not that sign of distress yet. Like in the financial crisis where debt wasn't available to anybody. That's one of the key things I'm going to talk about in the debt section. But prices, while they are up overall nationally, there are some pockets that are a little bit different. If we look at the main property types, the CBD office market is showing some weakness. That's the dark blue line here. And we've seen, over the last year, there have been some declines. Now, a big part of that, as I'll get into in a second, is Manhattan. And there's been some changes in terms of what's happening in Manhattan. Other sectors, though, have a different pace. The apartment sector continues to go up at a healthy clip. The industrial market, we've seen a little bit of a dip in the industrial market in recent months, but I almost feel like that's just a temporary correction. You have a very deep pool of investors looking to get into industrial, looking to get into sort of the infrastructure of the internet. So that's been a healthy story. The other ones that are healthy of late, the office sector for suburban areas is starting to see a bit of an uptick. I've got some comments on that a little bit later. We've seen a change in terms of what investors are interested in the office markets. The laggard, of course, is retail. That's the bright blue line at the bottom. The thing to take away from this chart for retail, here's the level today in 2018. Here's a level a little bit higher than that back in 2007. We've never reversed those declines from that financial crisis. Some people look at that and think, well, hey, it's got some room to grow to get back to that previous peak. And maybe for some property types it does. There are certain deals in the most recent periods tied to some of the highest quality assets in the market with, say, the Westfield acquisition by Unibail. And there's a few other large portfolio plays where some of the smartest money in the world is looking at some of those platforms as a way to get exposure to high quality assets that are somewhat bucking the trend of challenges in the retail world. But price trends, again, the decline in volume, some investors are looking at it and thinking, hey, it's an opportunity, I'm going to buy everything on the cheap. And they're almost kind of surprised a couple of years in that everything hasn't dropped yet in terms of prices. The CBD office stuff, one of the reasons that's dropping is that Manhattan prices are starting to change. So Manhattan in particular, again, this is our commercial property price index for the 6 biggest markets in the United States. And if we had a peak in the market in 2015 in terms of deal volume, you want to compare this peak with the peak just before the financial crisis, the thing I take away from this chart is that prices today are all over the map compared to the previous one, the previous peak and aftermath. The previous peak and aftermath, everybody went down together. There was no safe harbor. When you remove debt from the capital stack, there was just no lending happening for a time. You're removing 40 to 70% of the capital stack, you're going to have a bad day. And that's what's different today. There's still an awful lot of debt out there. You have changes, though, at the market level based on the composition of investors who come in, the expectations for growth in those markets, and the set of investments that are available. They all combine to change prices in a different pattern today compared to the past. So if we look at some of the markets here, DC is sort of the dark blue line. It saw a bit of a peak in 2015 and was on a downward trend after that. All the concerns around budget discussions in Congress and fears of dysfunction were kind of souring investors on that. Plus, some construction had come into Center City with changes in GSA requirements. So, investors just weren't as excited about the opportunity set in DC for a bit. Yet, in recent periods, we've seen a little bit of growth in prices. Chicago, the bright blue line all the way at the bottom. And sometimes people tell me I'm too negative about Chicago only because I'm from there originally. But clearly it's the case that Chicago is just barely above the peak level set in 2007. It's the laggard of this collection of markets. But others saw just tremendous growth in this cycle. San Francisco, Boston, New York, LA, they're well above that previous peak. But Manhattan is the one that's down a lot recently. That one, it's the dark orange, it's that sharp decline. That's got some people a little bit concerned. And again, some are concerned, some are optimistic in the sense of thinking, this is just the canary in the coal mine. Everybody's going to do this soon, and I'm going to be able to buy everything on the cheap. I think they're wrong in that sense. I think that the price change we've seen in Manhattan of late is really just a composition change in terms of who's buying in the market. If we look at the Chinese, they've really pulled back in recent years. What I'm showing here is just the composition of what Chinese investors have bought in the United States since 2007. And really, 2007, they weren't active yet. Sort of there, in the years after, they really started ramping up. But, they bought about $55 billion in terms of commercial real estate from that period. That's the big pie. And the small pie, the $5.3 billion in dispositions, that's all they sold, sort of the satellite of Jupiter there. Yeah, but that sale, it's much more recent. The timing of that is that, into the second quarter of this year, Chinese investors became net sellers for the first time, selling more than they bought. And so that smaller pie, I think, is going to be getting bigger. Clearly in Manhattan, they've changed the dynamics. In 2017, early 2017, those buyers really started to disappear from bidding pools. In the years before, in 2014, 15, 16, whether or not they always bought the best asset in the market, they were always involved in the bidding, and they were always some of the most aggressive bidders in any bidding pool from all the brokers I've talked with. So their pullback led to a bit of a market pause in Manhattan in 2017. Deal volume was down, and finally prices started to adjust this year. Now, as prices adjusted, deal volume's back up. Some of the investors who were sitting on the sidelines saw the change and realized, okay, I've got enough of a change in price, so I'm going to get back in. So I think that decline in Manhattan, it's not a precursor to a broader downturn. I think it's just a story about changes in Manhattan and changes in the supply and demand dynamics between owners and buyers. So in terms of the property markets overall, it is the case that we have record low cap rates and high prices at different levels. When you look at all that, investors trying to find some sort of opportunity in the investment market, they're really struggling because they're having to pick over things from different parts of the cycle that had been traded already. One way I think about it is where can you find relative value in terms of investment? If you believe that cap rates are low and they're going to revert to some sort of mean level at some point, then there's clearly some sectors that are better than others. What I've highlighted here are not just property types, but major subtypes of different property sectors we track. And the first column is sort of the average cap rate for the last 12 months versus all time. There's sort of four buckets I've got here. Up in the green, those are property subtypes, where cap rates, the spread to that long-term average shows that, they don't have as far to mean revert if that in fact happens. So there's probably a little bit better value. Strip retail, the stuff that's not anchored as much, a lot of out parcels, a lot of triple net shop type space. Their cap rates have already seen some movement, and you have cap rates there much closer to the long-term average than any other subtype. I mentioned how Manhattan and CBD office prices are down. If you look sort of in that second to last segment, you have CBD office cap rates around 60 basis points lower than the long-term average. One thing I get into in the property subtypes a little bit later, the suburban office, it's a little bit better pricing opportunity and a higher yield and not as far away from that long-term average. I think that's one of the reasons we're starting to see more deal volume in the suburbs right now, because I think investors see a little bit better opportunities there. So, the debt markets. I brought up this notion that investors are, looking at the property market and are, not selling in a panic today, in part because the debt markets are still liquid. There's still a lot of investors looking for the yield component that you might get in a debt investment, and it's a very liquid market. I mean, so much so that if we look at the total capital flows to commercial real estate, there's been much more capital flowing into refinancing activity, since the market peak in 2015, market peak of volume, I should say, than into the sell side. So the dark blue here in this chart, that is the capital going into sales, just the purchase of properties. The light blue in the middle is amount going into refinancing, and the gray is construction activity. the numbers to take a look at here that I think are interesting are the percent shares. In 2015, 51% of all the capital coming into the market was from new acquisitions, and only 31% was kind of refinancing capital. Into 2017, a lot of owners looking at some sort of capital need, rather than selling and testing the waters there, they were simply refinancing. 41% of the capital flowing to the market in 2017 was refinancing activity, as opposed to the 40% that were sale activity. So, that was clearly a case of sellers or of owners kind of sitting on the sidelines testing the water. Now it's starting to change a bit into 2018. It's gone back a little bit the other direction, but still kind of equivalent. 41% sales, 39% refinancing. So it's a little bit more balanced now. I think some markets, particularly Manhattan, where they were still trying to test the waters on what was going on now that the Chinese were gone. Buyers and sellers a little bit closer, and that's why you see some changes in deal volume. But one thing that's also supporting the ability to go to the market and find debt options is that it's a very diverse pool of lenders in the market. But right after the global financial crisis, you saw a tremendous collapse in the number of lenders and the breadth of lender types that were active. For a time, you had some bank lending, GSEs, and life insurance companies, and that was about it. And heaven help you if you did not have an existing relationship with one of those banks or one of those life companies, because they weren't going to be giving you capital unless you already had an existing relationship. They were rationing capital only to folks where they had a good relationship. Today, the thing to take away from this chart, you have a number of different capital sources. Up at the top, the 2018 first half figures. Now, all the oranges, those are different types of banks. The lightest orange is kind of your local and regional bank. The middle one is kind of large national banks, and then the darkest orange are the global banks. And they're a big chunk of lending, but they're not so dominant where they take on everything. The GSEs are around 20% of the market. That's the agency in there. Insurance companies are a component, and CMBS around 16. The thing I look at here is just there's so much competition. Everybody wants a piece of the market, and they're all very active today. And that is helping to change the dynamics a bit. Even though interest rates are going up, mortgage rates have not skyrocketed. There's so much competition that it kind of keeps some pressure there for lenders to work on the spread themselves, so they can continue to have enough volume to keep the businesses going. But that said, they're still lending conservatively. It's not as though that competition is leading to risky loans at this point. Now some lenders are making a little bit of a move there. Some of the debt funds are being a little bit more aggressive than others, but there's still a small portion of the market. But looking here in the last up cycle to down cycle, the debt service coverage ratio for debt and the amount of capital to cover the payments on a loan, that chased cap rates down. Lenders are willing to make riskier and riskier loans as cap rates declined. In this cycle, they've not. They've been making much more conservative loans in this cycle. So that even if we hit a roadblock, knock on wood that we don't have a recession in the next 2 years, but if we did, some of the loans have been originated. They'll have a lot more cushion today to kind of weather whatever storm we go through than what we had in 07 and 08. Now, sometimes, though, people are a little bit afraid about construction in the sense of if I own existing property, what happens when somebody else builds an asset and comes in and competes with me? And sometimes regulation there could be a good thing. We introduced something in the financial sector, the high volatility commercial real estate regulations. They came in 2015. And I don't think it was planned to act this way, but it came in at just the right time to start to take a little bit of the wind out of construction activity. And I'm going to have a couple comments on that later on the apartment sector. But you can see here, the blue bars track a survey from the Federal Reserve Bank looking at senior loan officers and their underwriting standards around construction loans. From from 2014 up until the end of 2015, there were more every period that were loosening standards rather than tightening standards. And then you can see the orange line that tracks our data on development site sales. And the development site sales were climbing in that period when lenders were becoming easier with money for construction. It kind of makes sense. If you make it easier for developers to get money, they're going to buy land and they're going to build. I mean, that's what developers do. You give them money, they build. But the introduction of those regulatory changes, that just shut off a lot of development site sales because suddenly they're tightening up those standards. People can't get the loans that they had before, and things start to change. Now, rolling all that forward to today, we went through the tightest periods through 2016, 17, starting into 18, it was easing. But and now in 18, we've seen some changes in the standards applied to the high volatility commercial real estate regulations. Some of the regulations as written at first were very loose, and that made some lenders hesitant to lend, so it didn't have sort of a gotcha type regulatory response from some of their regulators. So they became a little more hesitant because of that. But now with the clarification there, I think that some of them may be a little more inclined to jump back in. Although once they do, there too, they're going to find a crowded space. Right? The capital markets, just like nature, abhors a vacuum. And with the capital source on lending from banks kind of pulling back from 2015 to 2017 in response to those changes, some other type of capital stepped up. We're showing it here. We're calling it financial. It's this kind of darker blue all the way up to the left. Financial, for us, it's financial company that really means debt funds. The debt funds, there's been a tremendous growth in these lenders, sort of non-bank financial company lenders in the last few years. There are a couple things driving this. One, as we were getting late in the cycle, a lot of equity investors tried to raise funds to do lending instead, thinking that, hey, if we're not going to see strong price growth, maybe it's time to make some more conservative investments just for the kind of yield I'm going to get on debt. And if something happens to go wrong on the property pricing later, at least I end up with a property that fits the type of activity I've done in the past. So we've seen some of these folks step up. The challenge, though, is that they've got much more expensive capital than the banks. The banks, they can raise money at a relatively low cost from deposits and the Fed discount window, whereas the debt funds, they've got a bunch of management fees in between. So they tended to look for high yield debt opportunities, both in the mezz space and then here in construction, kind of stepping in as a lender of last resort in some cases. So now they're, so far in 2018, about 20% of all construction lending. And that's becoming a big share. I think it will be interesting to see in 2019 and 2020, now that to some extent the banks, the gloves are off and they can lend without some of the restrictions and the fears that were in place with the high volatility commercial real estate regulations, that maybe they gain back some of the share that they had in the past. And they had that share in the past. They're kind of the natural capital source for a lot of construction stuff, given that they tend to be locally focused and more tied in with the local developers active in those markets. So different property sectors to talk about. The office market. I mentioned a little bit earlier on that relative value that there's more of a move towards suburban activity. And I'm showing that here, kind of segmenting the deal volume for the CBD office market versus the suburban office market. I'm segmenting it not just by the main type, but also by the deal structures involved. The darkest blues at the bottom, that's where investors are coming in and buying a single building at a time. And then the different lighter shades of blue up above, they're buying either a portfolio or so-called entity level transactions, just buying a whole company, trying to get at the assets. And the classic office entity level transaction, that's like the take private transaction of equity office back in the previous boom. So, those entity level transactions, are taking the deal volume for the suburban market down a bit. You can see that we hit a peak in 2015 and it went down a bit, and it's been up and it's down a little bit more. It's a little bit of a roller coaster there on those portfolio plays for suburbans. But this dark blue underneath, that's a hopeful sign in my mind for the suburban office market. I just put some numbers on it. And the orange lines here, for individual asset sales, that shows the peak level of individual asset sales back in 2007. For the CBD market, you can see that we were maybe at the peak in 2015 and 2017, around $5 billion short of the peak sale activity for individual assets in 2007. But in this cycle, that's different. In this cycle, we're maybe 10 billion above the 2007 peak. And that's a very recent thing, and it's a bit of a sea change from earlier in this cycle. Early in this cycle, everything, every conference I went to, everything was millennial, millennial, millennial. Everybody wants to work in the city and live in the city, and so we should locate there. We should only buy suburban office buildings. Heaven help the owner of a suburban office building, because nobody's ever going to move to the suburbs again. Well, guess what? 10 years on, the millennials are older now. They're no longer just out of college. They're pairing off. They're starting families. Some of them are moving to the suburbs. Firms are finding it easier to attract labor to suburban locations. There's price benefits for both the workers and firms. And now for the investors, they're following them. They're following them because there's a yield opportunity as well. And so we're now at a record level high of individual asset sales in the suburbs. And this is a change from earlier in the cycle. Now, this is not to say that every suburban office asset is suddenly a buy opportunity. There are differences within the suburban office markets in terms of the types of properties that people are willing to buy. That 1980s vintage building down at the end of a cul-de-sac where you can't walk to anything nearby, and maybe it's got a green marble interior and brass and oak paneling. I think we've all seen some buildings like that. You're going to have a hard time with that building. Something that has sort of mixed use nearby, maybe some transit options besides just the car, whether that's a quick electric scooter ride to the local transit stop or buses or whatever. That's going to get much more investor activity and frankly, much more tenant activity. So taking some of the features of urbanity and bringing it into kind of denser suburban locations. But that stuff is much more of interest to investors at this point, and the prices are reacting as well. So the industrial market is, I noted earlier, you've got some price growth underway for the industrial market. Deal volume is okay. It's on a track for a good year. I'm showing here sort of cumulative monthly deal volume. You have months along the x-axis, and then the dollars invested on a cumulative basis on the y-axis. And so you can see, each line represents a different year, and you can see where we are relative to previous years. For total deal activity, the dark blue, through mid-year 2015 was sort of the peak level, and 2018 is below that at the moment. But part of that is just, it's tied up in this whole merger and acquisition world. The entity level transactions have been at a good clip so far in 2018, but they were stronger in 2018. This year, we've seen the GLP and a take private transaction and involving some cross-border investors. There have been other portfolio deals in the industrial sector announced. They haven't fully closed yet. There's a lot of activity, but it's not quite at the 2015 peak levels of activity. So we're on pace to come in for a good year. If it continues at this pace through July over the rest of the year, this will be just behind 2015 in terms of deal activity. But that's looking at a little bit distorted by those mega deals. But when we strip below that and look at just the sale of individual assets. And that's kind of the bedrock of the market, because that's an investor looking at one building and making a decision about the industrial market itself based on the quality of the tenant, the quality of the building, the quality of the area. And their deal activity so far this year is ahead of any previous year. Their investors are clearly excited about the opportunity. They look at this and they think that there are things happening that as people move activity out of the store and into and onto the internet, that the supply chain needs for that are a long-term story, that they think that there will be a steady flow of income on that, and it's something that a lot of investors want to be part of. So I think the industrial sector, there's still some signs of healthy growth there, and it's something that the pricing has reacted, but this volume stuff makes me think that that's why that little dip we saw in industrial prices is not a permanent thing. That's just sort of a temporary action that's going to continue to climb. If you're at a record level of deal volume, and every investor understands the story of moving off of the bricks and substituting it for clicks, that that is a trend I think will continue. So retail, I feel bad for retail investors in some ways, because they suddenly become everybody's whipping boy. But I still think there are opportunities in the retail sector. I know where I live, there's some malls there that just have tremendous foot traffic, every weekend. I'm in New York, a highly dense urban environment, a lot of good jobs, and I think there's differences in the retail market. One of the challenges that we see is that there is a much wider gap between buyer and seller expectations in the retail market than in other sectors. If I have the best of the best asset, why should I sell it? If I have the winning mall that has all the best luxury retailers, has a great location, it has the foot traffic, yeah, I could probably sell it for a tremendous price today, but what am I going to do with that capital afterwards? There's no better investment for some of those assets that invest. Fire truck. There's no better investment for some of those investors to put their capital into. So I tend to discount some of those the sky is falling type stories you'll see in the business press. There have been some malls that have gone through some changes. If you look at some of the malls involved in, say, the Centro deal back in 2007, some of these, when we look through the figures, it sold anywhere, when we try and allocate the prices, maybe anywhere from $200 to $250 a square foot at that time. I'm looking at some of those trading today anywhere from $10 to $20 a square foot. So that, for those individual malls, that's a tremendous loss of equity. The challenge is the malls that went through that weren't the ones that people are holding on to. They're the ones in sort of the manufacturing-based economies that have fundamentally changed. It's a lot of older assets built, say, in the 60s and 70s with some deferred maintenance, maybe orange carpeting and brown tile, that kind of style from the 70s needs a lot of capex to get up to speed. And you're not going to do that in a market where the income base tied to manufacturing jobs has changed and gone away. So that type of asset just isn't as attractive today, and that's the stuff that's selling at a tremendous discount. Now, for the market overall, even when you get to sort of assets that are performing, there's differences in terms of the relative value for different types of retail properties. So I did that kind of cap rate analysis here for just these different retail subtypes, and the one that's at the most extreme level of pricing, it's kind of urban retail, urban storefront type product. Yes, cap rates are on their way up there. We look into mid 2016, it was around a 4.7 for a cap rate in that type of asset class, and it's up to about a 5.1 today. So it's adjusted a little bit given some changes there, but it's still well below the long-term trend. The long-term trend is 95, close to 100 basis points lower. And so if you're worried about sort of a mean reversion, maybe that's the type that's a little bit further along. The stuff where investors have not bid up the value of assets as much, all the way at the top, sort of anchored centers. So this is going to be your neighborhood and community center anchored by, say Target, Walmart, that type of center. You're only about 50 basis points lower than the long-run average. But some of those centers, investors view them as more risky because some of them are dealing with commodity-type retail purchases, and there's a fear of that being eroded away by the internet. That said, some of these yields, above 7%, that's a hard thing to find in many parts of the investment world. So there are some investors looking at that as an opportunity set. Single tenant retail is one that we had the interest rate change start in December of 2016, and that sector has seen a bit of a change in cap rates in response. You look at a single tenant retail, that's typically a triple net lease type retail. You had cap rates below 6%, and now they're up at about 6.2%. It's still one of the most pricey asset classes in the sense of cap rates relative to the long-term average, around 80 basis points lower. But there's not as much room there once interest rates start going up for cap rates not to respond. And this I have some comments on in the next section. But cap rates and interest rates don't always move in a one-to-one fashion. They are related, but they do follow their own path because of the potential for income growth to come. That gives you higher quality income streams and increases the value of the property. Now, triple net retail, of course, you've got a fixed set of payments, and so there's no upside if rents are going up. But with the single tenant retail tenants, even though there's no upside for rent, the quality of the rent that those tenants are paying you, just given changes in the financial markets, is higher quality now. If you have a fixed set of payments from a tenant in a slow growth economy, you don't know if in a slow growth economy if their business is going to survive. But we've seen a faster pace of growth since 2016, and we're starting to see some increases in wages finally, and that makes some of these drugstore retailers more viable operations. Maybe you, as the property owner, don't capture any of that in higher rent, but you do capture it in the sense that they don't have to spend as much of their free cash flow on their rent anymore. So they're a safer bet in that sense. That's why cap rates for that space have not gone up nearly as much as interest rates. But the apartment market, that was one that I mentioned earlier in terms of construction and construction fears, and that was certainly earlier in this cycle. You were starting to see some warning flags raised about that. Now, I live here in New York, and in my neighborhood in Brooklyn, I live in a brand new tower building, and I look out and I see cranes everywhere. There are a tremendous number of apartment projects going into my neighborhood, and as I travel through the country, there's certain cities where you see a lot of that. Seattle, that's one of the markets with an awful lot of construction underway for the apartment market, and the rise in prices in the apartment market led a lot of investors saying to themselves, I want to get into that market, but things are looking pricey, and there's still ongoing demand, and if I can't buy it, I'll build it. And so prices got up a high enough level, and a lot of investors thought they'd start to build. I think that's really starting to cool. What I'm showing here is the value of construction starts from our database for the apartment market nationally. And you can see that quarter after quarter after quarter, you're always up relative to the previous year, all the way through Q2 of 17, and it's been on a decline since then. Really, I think what happened here, Q2 17, you sort of hit the peak of the value of construction starts for apartment. Back in 2015 is when those high volatility commercial real estate regulations really clicked in, there's a lag effect. You get a loan, you go through parts of the due diligence on getting the project going, and then you start. So the debt changes in 2015. It didn't have an immediate impact on starts. There were already some projects that had all their draws lined up with the lenders, already had the sites, already had the plans, entitlement, and they were going. But the 2015 changes, I think, we're on the tail end of that now, where that decline in land sales that came about more immediately after the changes in the regulations, we're really starting to see the final impact of that. And so we're at the peak level of construction in the near term for the apartment market. And, it is the case that they've normalized some of the regulations around high volatility commercial real estate. So these lenders don't feel as scared to make loans today. But I think that it's not as though, tomorrow they're going to start building aggressively. It's going to take a while to get the lenders active, meeting developers, getting projects going, identifying sites. So it will be some time before we get back above the 30 billion per quarter kind of start level that we saw in mid-year 2017. So, yes, there were some supply concerns in the apartment market, but in the near term, I think we're at about the highest level we're going to be for a bit. With that in mind, I wanted to close before some questions on some of my thoughts on what's going to happen next on prices. A simple way to think about price, you've got the cap rates and all, you have a certain amount of income, and then given debt and capital market forces, you take a look at that and you figure out what the price should be. So you can decompose that price to, changes in the price should then be a function of changes in income and changes in those capital market forces. And so I took our CPPI for the CBD office sector, and I decomposed the changes in that way. The orange you see here, that is the change in NOI in every period. And the gray is a change in the capital market forces that drive prices. And then the sum of these two bars equals the change in the RCA CPPI. And I noted how CBD office is seeing a change and showing some declines in prices. And you can see that here on the chart. But the NOI, and we're getting that from NCREIF, NOI growth is still positive. It's not at double-digit rates. It's hardly ever been close to double-digit rates. You had a period in 2007 where it was close to double-digit rates for a bit, and the period in the recovery in 2013, 2014 when it was in double-digit rates. But you don't have to be at double-digit rates. It's a nice, steady performer. You're above inflation, and that NOI growth is something good for a lot of investors. They want some stable NOI. But the CBD office space, the investor interest had suddenly changed when HNA was looking at the markets and saying, given what our regulators had told us back in China, we need to sell some buildings. You remove them from some of the bidding pools. They had been active in parts of the market, so that had started to change some of the highest bidding activity around some of the highest quality CBD office buildings. But fundamentally, the income is still in place. So it's not a big decline in the prices, I think, moving forward like it was in this period. And largely, too, because it's not as though there are owners who are being forced to sell. There's not somebody like, say, a Broadway Partners that was so aggressively buying pieces of the equity office portfolio that once they got upside down with the assets, had to sell everything at a discount. We don't have the lending coming in today in such an aggressive way that people are only counting on outside for income growth to make the investments live. It's just a technical change in terms of some of the top bidders are leaving the market. I think eventually that price growth starts to stabilize. But one question always comes up on that, and sometimes I feel almost hopefully investors are coming to me on this, thinking that, hey, eventually interest rates are going to go up and cap rates will. I say hopefully on that because I think some of them look at that and think, I'm going to be able to buy everything on the cheap once cap rates are higher. But they've been saying that for a couple of years now. I started hearing talk like that in 2015 from a lot of investors, and cap rates actually have gone down a bit since. I think interest rates will go up a little bit more. I'm showing here a survey of some of the leading economists in the United States that the Wall Street Journal does every month. The black line is sort of their central expectation moving forward on where they think the 10-year Treasury will go. And effectively, by the end of 2020, they see about another 50 basis points of increase in the 10-year Treasury. And those gray lines around that, I mean, if you ask 50 economists something, you're going to get 100 answers. And so that shows sort of the variability of responses on the part of all these folks. And so in a probability sense, sort of within one standard deviation, you may be anywhere from a 4% to a 3% in the 10-year Treasury in 2 years. So there's some uncertainty in terms of where they go. I mean, and the 3%, I find that a view somewhat interesting. There's almost as many folks out there thinking that we're about where we're going to be on the 10-year Treasury and not go any higher. And so if that's the case, then maybe cap rates don't have to move much if you're sort of that view on interest rates moving forward. But for the market average, maybe another 50 basis points. And so you look at that and think, okay, if we get another 50 basis points of increase in the 10-year Treasury, must that then finally start to drive the change in cap rates that people have been talking about for so long? And there too, maybe not. What I'm showing here are is sort of a decomposition of cap rates, and more than just a decomposition to the 10-year Treasury versus the cap rates, but also looking at sort of the impact of debt. The sum of these three bars represents the commercial cap rate in the United States, and the gray at the bottom is the 10-year Treasury, but then there's a light blue on top of that, and that's a spread between a 7 and 10-year fixed mortgage rate and that risk-free rate of interest rates. And one of the things to take away here is that as interest rates rose, that spread that the lenders were willing to take on, that narrowed first. And right now it's around 190 basis point spread versus around 230 basis points over time. So there's a little bit of competition there from all those different lenders that are active today. And rather than jacking up the rates right away in response to the the interest rate changes, they're becoming a little bit more competitive. But then on top of that, the blue, that's the spread between the mortgage rate and the cap rate. And I think that's a nice back of the envelope way of thinking about the viability of investments. I mean, if you go back to this boom period, there was virtually no spread between cap rates and mortgage rates on average. The only way investors could get out of those investments alive was by having income grow well above 10% per year. And, historically, you don't see many periods where that happens. But there were investments made in that time period where people were going into their Argus runs and underwriting 10% per year rent growth ad infinitum. They were diluting themselves, and they paid the price for it. Today, there's a lot more spread in place, and that goes along with more conservative investments and more judicious buys. Yes, interest rates may go up some more, but honestly, if they do go up, I think that's a healthy thing for the economy. Low interest rates, the way they've been so low for so long, that's a sign of a weak economy. That's a sign of weak investor demand, weak wage growth, and all the stuff why people need real estate for housing jobs and housing shopping. That's just a sign of weakness. If you have growth in interest rates, that's a sign of, hey, some competition in the markets for capital because of wage growth, because of requirements for further investment. And fundamentally, that'll help improve property income. So, again, maybe like with that single tenant net lease, maybe you don't get as much of it, but it makes the riskiness around that income a little less. And so cap rates, I think, don't have to go up in a one-to-one fashion, even from this point forward. Maybe you get a little bit of an increase if you have a 50 basis point increase in the 10-year Treasury. But, given where spreads are relative to those longer-term figures, it doesn't have to be one-to-one. Back of the envelope, I've been thinking that maybe for every, additional 10 points of increase moving forward, you get about 5 in the 10-year Treasury, you get about 5 basis points of cap rate increase. But we'll see how that back of the envelope forecast starts to pan out. I see that we have a couple questions that came in, but just in summary, first, just want to thank everybody for sitting through this today. But I just the fundamental story I want to leave you with is that, yeah, deal volume is down. There's been some noise around that of late. It's not a sign of any impending doom. It's just a sign of some changes as the asset class comes off of a period of recovery and expansion from change in the interest rate environment to something more normal where buyers and sellers all have to be judicious in terms of how they look at every investment. And with that, I thought maybe we could take some of the questions.
Thank you, Scott. Thank you, Jim. The first one is someone asked about the slides. They are attached to the handouts, so you should be able to access them, and everyone will be receiving a recording automatically in an hour or two, and I think the slides will be attached there also.
And then if you have questions about the slides later as well, I'd say, I'm easy to find, and if there's something that doesn't quite make sense, and there's a few things I kind of skipped over just to make sure I hit the time, I'm happy to answer questions later.
Thank you. So what is driving the explosion of apartment growth nationally?
Okay, the apartment market, what's driving the growth there? This cycle has been all about the apartment market. That was after the global financial crisis. You had that backdoor demand of people who had been in the single-family market and then had to find someplace else to live and went to the apartment market. But that continues, and demographics drive it. You have the baby boomers entering an age range where some of them have need for that kind of rental unit instead. The millennial generation, even though like I said, they're aging out of that post-college world, there's still a state where they have a tremendous demand for kind of rental housing, and those kind of demographic trends. I think a lot of investors see that, and a lot of investors do kind of theme-based investing. What's the broad theme of the economy, and how do I find a real estate solution that helps satisfy that demographic or economic need? And I think that's what's driving a lot of capital into the apartment sector.
Thank you. So next question, how is the co-working trend affecting the office market today and the future?
Co-working is interesting, and we in my company here at Real Capital Analytics, we've got some satellite offices and some WeWork locations, and I've popped in and visited those folks from time to time, and I think it's an interesting type of work environment. There's a lot of uncertainty around it, and part of it is that we don't have a lot of data, even ourselves, and I've been trying to figure out how we can expand what we have, because I looked and I saw that we had about 17 buildings where we saw the transaction, and there was a WeWork inside the building. There's not too many buildings that have WeWork as a tenant that have sold, so it's hard to tell what's happened to prices. But I think that that's not enough observations to make a determination of what is the value of WeWork in a building. There's some people that have said that it's a great value. Some people said that it's not. There's just not enough data to tell. But it certainly changed some of the competitive dynamics, because the sublease market is not quite what it was before. And in the past, when you had growing firms, they could take a space and get rid of it and just offload on the sublease market. So it changes some of the dynamics of the income you might receive for a building, in the sense that if a firm doesn't need that space anymore, they're going to have a harder time unleasing part of it, because the type of people they would have leased it to in the past are now over at WeWork. And so that changes that dynamic. There's also changes, I think, it's not just these kind of co-working places are not just your average everyday type of tenant. I think there hasn't been enough attention paid yet. I don't have enough data on this, but I have my own firsthand observations. The building I'm in here in Manhattan, 3 floors below us, there's a couple of co-working floors, and the elevators are always full. There's always people coming in and out, and I think that there's probably some more wear and tear on the building because of that. So maybe there's a CapEx thing that people haven't fully figured out yet.
Okay, next question. With the change in investment from the Chinese, what country or investment will come in to replace or cause an uptake in U.S. real estate?
Well, a couple things on that. An uptick in U.S. real estate from cross-border money, maybe that doesn't happen quite like that as in the past. The Chinese coming here was kind of interesting because this was their first time here, and a brand new investor in a market, they have to do things maybe at the top of the market almost as an advertising cost, and pay the top price so people know who they are. So that they can see the best packages come around to their desk later when there's other opportunities out there. There are other investors that are coming in, and we do see some growth. The leading investors now are the folks who had been leading in the past, the Canadian investors. And it makes sense for the Canadians to come here because, well, number one, most of the U.S. investment market is within a 2-hour flight of Pearson. So it's just easy for all the funds that are largely in Toronto to get down here and see assets. And we speak the same language, and it's just easier for them to understand our markets compared to other markets globally. But as they come here, they're not doing the same types of things as the Chinese necessarily. I feel that sometimes cross-border investor can be code for an investor who overpays. And I don't think that there's anybody who's going to be so new to the market that they want to be aggressive and bid up the value of assets just to show that they can. I think you're in a period where you're still going to have a lot of cross-border investors coming here, but they're going to be judicious and looking for nice stable yield. And so I don't think anybody kind of replaces the kind of activity that the Chinese were doing. Especially on the development side. They were doing things in development that other cross-border investors had never really done before. But, I think, we settle into sort of a more balanced market where you have some more cautious buyers moving forward.
Thank you. Do you feel the federal government is putting pressure on the Fed to keep the interest rate artificially low? What rate do you feel is a healthy rate?
The Fed, I think, is going to do what it does, and there's sort of a bias on the part of those folks, I think, to keep moving that short-term rate up, if nothing else. Where you sit determines where you stand, and if I'm a regulator at the Fed, I'm worried about not having the right tool set available to me for the next downturn. If there's a recession in 2 years. I think they'd like to have a little bit of leeway in terms of being able to move short-term rates to help use the traditional tool sets to get through the next recession. The thing that we learned in this last downturn, they used that QE tool for the first time, and I think from their perspective, they're unwinding QE. They want to kind of reduce the size of the Fed balance sheet, and they don't want to have to keep going back to that tool. And so if they can increase the short-term rates a little bit to give themselves a couple bullets in the gun for the next one, that saves them from having to use the dynamite of QE in the next downturn.
Okay, we'll take one more question. Will the trade deals being negotiated with other countries affect any segment of the real estate market more than others?
And the trade stuff, the real challenge there is that it's hard to say what's going to happen on the fundamental side in terms of impacts on property income and investor demand for certain areas, because we don't know what the trade deals are going to look like yet. It's kind of chaotic in that response. What I will say though is that I don't think like at the AFIRE meeting, Association of Foreign Investors in Real Estate, it's sort of the first big CRE conference that comes out of after Labor Day. I'm sitting there talking with a lot of German and Dutch type investors, and as you might guess, a big meeting like that in DC, subjects of politics come up a lot, and some of the foreign investors don't understand our politics very well and aren't very pleased with what they see. Yet they're still very happy to invest here. They'll go into a diatribe about challenges with President Trump, but then they calm down and say, but I still love the United States. There's still all kinds of opportunities here. And so, whatever happens with the trade stuff, as long as, we still have a fundamentally productive economy, I don't think that's going to change that investor appetite for coming here.
Okay, so thank you, Jim. This was very informative. And I know people are requesting the slides, which if you look in your control panel are in the handouts section, and you will be receiving a recording shortly. And I really appreciate you coming on, and especially for filling in last minute for Bob White. And thank you so much.
Hey, no worries. Thank you so much, everybody.
Have a great day.
Bye-bye.